A very pleasant good evening, ladies and gentlemen, and hearty welcome to each one of you for today's study circle meet. Today we have with us an eminent speaker, CA Pradyumna Nag, to present on the topic and to give a very brief introduction about him. He is a partner at Prequate Advisory, a 10-year-old awarded management financial advisory, which has been featured regularly by publications for its breakthrough approach to blending financial advisory and management consulting. He has managed a wide set of relationships in business and strategic finance engagement with clients, ranging from listed companies across the world to startup that includes organizations from the portfolio of top-tier VCs. He has been a speaker at Entrepreneur India Summit, Indonesia Economic Forum, PE VC Summit, and various professional bodies and trade associations. He speaks on the topic as strategic finance, valuation, private equity, and strategic planning. With this very brief introduction, I welcome you for today's program, sir. Hearty welcome to you once again on behalf of Bangalore branch of SIRC of ICI and request you to kindly take the session.
Thanks, Divya. Are you able to hear me okay? Let me start with that. Okay. So thanks for having me on. This is a topic which is close to my heart and absolutely like anything else in the profession. If it earns you your rosy roti, you tend to develop an emotional bond towards it. So I guess this is a topic where we have, spent a number of years kind of building the skill set. We started off purely from a practice angle, and I have over the last 14 plus years, built a strong suit around strategic CFO advisory. Right. So whatever I'm going to be doing in this study circle over the next hour and a half to 2 hours is going to be focused to give you a glimpse or an insight about what the role of a CFO is today and how it's changed from the yesteryears where we were the bean counters or we were the number crunchers to being partners to an organization itself, right? So that's kind of been the calling card for really thorough, really good professionals of late, as they've been taking more and more serious management roles, CXO positions or CEO positions. To give you an example, the ex-CEO of, the current CEO of Uber is a CFO of in his previous life, right? So the way we look at numbers adds a very objective view that nobody else can kind of replace, and that's helped us as a professional itself to become more and more important from an organization standpoint and play a larger role, right? A role which is not limited to just compliance, not limited to accounting, but moving into what finance really means. So without really delving upon it, I'll just get right into the topic itself. So most professionals or most finance professionals, unfortunately, are bred with the thinking that finance is accounting and compliance, right? So, but you're seeing a lot of uptake in FP&A as a practice, right? And now you're looking at a lot of those FP&A functionaries becoming CFOs and CFOs becoming CEOs, right? Like, so as this trajectory in the organization itself is kind of moving towards using finance in a more deeper manner, we have to replace our mindset to allow ourselves to think about what the potential of finance is and how CFOs at the helm, like as a finance leader, can play a much larger role than just assisting on these two functions, which are the bare bones of finance function itself, but are not the value driving functions. So what is it that differs the role of a CFO from, let's say, your finance controller or your finance and accounting team, right? Or your management reporting, or sorry, financial reporting team. Now, if you look at the first three boxes, right? Like when you're seeing the size of the function, it's loaded with the accounting staff, the guys who ensure that all the numbers, all the records are being maintained in a timely manner. We're compliant with the rules and regulations of the land. We are also providing basic amount of insight to the management of what is happening. And we are sort of the custodians or the guardians of any external agency, especially from a numbers angle, who's approaching us from a numbers angle. But Over the last few years, as the business models have gotten a little more complex, the competitive environment has significantly changed or has significantly become more and more flatter with organizations across the world vying for the same business. The role of a CFO has become more on the lines of the top two boxes, right? So even now, a large set of clients that we work with or clients that I have encountered personally in my past still limit the role of a CFO to the financial planning, right? So they kind of think that that is the value addition that they're able to bring in any organization, which is stopping short to what we can really do. Now, the role of a finance leader from the strategic finance angle is growing. Fundraising is just one of the things which is there. But if you really look at the wild gamut of things that a CFO can do for an organization, he can put an objective number to everything, right? Whether it's a goal, whether it's a plan, uh, he can quantify what that means, and that value is extremely critical or extremely important for an organization. Simply because they have not, from a business perspective, they can look only near term, or they can look at long term from a product perspective, but they cannot look at what that means from a numbers perspective and whether or not they should be even heading down that path. So we play that qualifier role of sorts to help organizations to move towards this more intelligent way of doing business, and that's the role of strategic finance. The second bit, which is very very important or very very critical, is how proactive the role is and how the expectation is forming internally from an organization or from a C-suite level stakeholder or a board of director or an advisor of what the role of a CFO should be, and it should not be to troubleshoot problems. That it should be to come in and find solutions to problems before they occur, or even foresee certain problems itself. So what is really missing? So if you look at professionals, so one very interesting thing that we also face when we're hiring for our firm, or even on working with organizations, we kind of feel a little bit of a gap when it comes to them being able to blend the technical knowledge that they have with the commercial aptitude that is required to survive and sustain finance as a function, because it means that they have to understand end to end of what is happening in the business itself, right? Like what a product means, what kind of market share does it have, and why is that important from a pricing standpoint? Why is that important from a costing standpoint? These are all decisions that they need to build capabilities to be able to analyze, and they need to be able to think longer term, right? So, CFO today works on par with the CEO. He's looking 5 years in, right? And apart from just the forecasts that are built, 5-year forecasts that are built, you have to be looking at the business and how it's going to evolve over time, rather than just saying that today's business or last year's balance sheet said X, I'm going to get you a X plus let's say 20% on your balance sheet. That's not the goal that you should be. I mean, that's the result of your activities. But in terms of what actions you need to be taking in order to say, okay, not about the next 1 year, but about the next 5 years. So that's the role of a CFO today, and that's how it's improving. The second thing is, in terms of us, the focus has been to be a great um, let's say second base player, right? So you're always there, you're always holding guard, you're helping the striker, or you're helping somebody to score all the big runs. Uh, but the role of a CFO has changed now. Now they're becoming leaders who are helping mobilize the assets within the organization. The assets are not limited to just the physical assets in the company, but are stretching beyond to the people assets, to the IP assets as well. Now, there a skill that we need to develop as professionals is the ability to persuade and influence people itself. CFOs today are speaking publicly about the decisions that the company is taking. They're talking, about plans to go public or to change revenue lines. So the role itself has matured to them being a primary wall of defense from the financial sense, to become a primary wall of defense between the outside world and the inside world. The last bit is from a purely analytical skills angle. So I think most of us are believing that a great analytical skill is the end goal, right? You need to be able to provide analysis that whether it is using Excel or SAS or R or whatever those tools are, you should be able to provide solutions to problems that are asked about. But today, the need of the hour is to also have skills to communicate these in the right way, communicate actionable insight, and communicate them at the point that it is required, which could be actually 6 months before something happened, right? So the best analysis is done years in advance, not at the time that there is an issue in the organization itself. So what does that kind of bring us to, right? So the finance leader itself and his role has become a lot larger. Now he's not talking about being a custodian, or he's not talking about managing the reporting. He's talking a bigger language, right? So a couple of questions that most of them ask: should he be involved in my business, right? How should he be involved? How deep should he go? Should he be overseeing my cash flow, or actually involved in the kind of products that I'm making? Should he be involved in the basic controllership of the organization, or should he be spending time on looking at M&A assets for me? Now, these are all things that earlier would come from the CEO. These are all management decisions that would come from the CEO. But as we've proceeded to become a much more mature organization, where everybody's capacities are being used in a more, let's say, in a deeper manner, the role of a finance leader is also becoming to lead change within the organization, to lead transformations within the organization. So he's not become the guy who is number crunching anymore, but he's becoming the people's leader. He's becoming the guy who can mobilize all the assets within the organization and help channel it to the right place, and help channel it to the right or growth opportunities. So if you look at what this really means, right, like the data is kind of clear. Uh, Over 51% are spending time on managerial matters and not really on their primary accounting, controllership, or budgeting process, which means that they're getting more and more deeper or more and more involved. The second thing is they are looking out for growth opportunities for the organizations actively, which is, many of the organizations are limiting their role to manage costs, or limiting their role to do performance reviews. But that's not how the future of the CFO role itself is going to look. They are looking at them to also facilitate this change, look at opportunities themselves, see what they can do to extrapolate the business value itself. And over time, that is what is going to pay off, right? For an organization, the only person who can be absolutely objective is the CFO, right? You have the CEO who's going to be extremely optimistic, right? It's a key skill set. You need to be very, very positive about the world and positive about the environment. But the guy who puts the guardrails about what this positivity means and how that's going to translate into business value itself is going to be the CFO. So that's one another very, very big change that's sort of happened with the role of a CFO. They are also looking at spending more time on transformations from the inside out, right? So it could be earlier, if you look at transformation, the limitation to corporate finance and transformation meant implementation of an ERP, right? But ERP is a very bare minimum kind of a game. It's going to tell garbage in, garbage out. If your data is not great, you're going to get really bad results. So his job was to ensure that clean data flows through the system, so it can be analyzed, it can be processed. But into converting it into action or advice is where they would give it to the CEO and say, okay, hey, here's what the data says. And then they would provide that information and the CEO would take an action. Today, they're looking at leading transformation projects themselves, right? So a large part of the CFOs today are looking at digital transformation for their businesses. It would earlier come only as a subset of a conversation about what can we do as an organization to improve or to reduce costs. But now the stem of what they should be doing as an organization for the long term is coming from the CFO's office. So this is a critical thing that we need to understand, right? So how does this distinction appear really when it comes to practice? So, one part of my role today, apart from just educating, this is all, yeah. But at the end of the day, what my role really is to give you a practical, real world insight about how CFO's role itself can be transformational for an organization based on things that we have encountered, things that we have done. So I'm going to start off with case studies, and we can always break and have questions coming in. But prima facie, the role is if I'm able to show you examples of how transformations happen, or how initiatives led and results are achieved, it could give you a frame of thinking for how to look at the CFO's role and how it matures in the organization, and how to look at our role and how we can play a larger role. Right? So it's not about giving you prescriptive guidance that this is what works. Like with every organization that we have worked with over the last 14 years, the experience has been very, very different. What works here will not work there. But it's the finance leaders' role to be able to sieve through multiple solutions and say, hey, this is what is going to work, or this is what is going to be important for this organization. And in order to do it, the approach itself might not be very straightforward, right? So because something worked very well for somebody else in another part of the world or within the same part of the world, it worked for, let's say, a listed company, doesn't mean it's going to work well for you, because there are nuances that every business is built on, right? So there is a case for why you as an organization and your DNA as who you are, or how you're functioning, or it could be even in terms of the clients that you work with, how they're operating itself. There are very, very small nuances that influence significantly on what kind of change is possible, what kind of transformation is possible. And knowing how to take that call is going to be one of the biggest skills that we have to cultivate as finance leaders. Now, when I say finance leaders, again, I'm not restricting it to just the CFOs, but I'm also including into the wider gamut outsource CFOs or practice CFOs or interim CFOs, or even finance professionals providing CFO advisory services to other organizations. So we have to be sensible or sensitive to know what is the change, what it requires to make that change, and whether or not this organization will benefit from a change like this. And that's why, with more and more experience of working with organizations, you get the knack to be able to judge that this is the strategy that will probably work, and this is probably the pain point with which you need to approach the problem itself. So I'll start off with one case study, right? So again, we've changed the names. Obviously, there's no company called Info, I'm assuming, but uh, Defo was one of the early companies that we worked with, where everything seems great. Like from the outside, that's a fantastic company. Honestly, it's a very investable company if you really ask them. As an organization, they're getting money in, they're churning out cash. But when you really look at the numbers, right, you realize that there is potential that they're absolutely losing out on. So if this company, again, I'm considering that it's a Bengaluru branch, ICAI that's having the study circle. I'm assuming that at least 50% of the client bases that you work with would be in technology services. So I have a few examples or a few case studies on the manufacturing side too, which I will get into later. And I have one completely agnostic case study. So basically three case studies. But in that three case studies, I have looked at the first case study, which is the most critical thing, and where I have realized most organizations actually do not do anything like this internally, right? Which is the opportunity for either an incoming CFO or an existing CFO to demonstrate significant improvement in value for the organization, or it could be even for a professional who's providing CFO advisory services, right? On what they can do and how do you identify a problem. So this company has about 500 odd people doing about $12 million. Again, I'm using the dollar language. I'm not using that. So please pardon me for that. It's just that the circles that I work with tend to be more familiar with that. And my mind, for some reason, kind of switches to millions rather than lakhs and crores, except when I look at my bank balance. So uh, if you look at them as an organization, nothing wrong. Company is growing steadily. It's a fairly old organization, but able to sustain and achieve growth, adding new business, no problems at all, right? And they have in the services business, every revenue growth dollar should yield back GP, which is in line with what you've been doing. And that should translate back into your FCFO, your free cash on the books. But this company was, for some reason, not able to achieve that same, delta. So if a delta happens from a CAG, from a revenue growth perspective, the delta is not happening from a cash flow growth perspective, right? Most organizations would have said, okay, it doesn't matter because we as an organization are growing steadily, wages are being paid, management compensation is going fine. we're able to accrue a lot of cash and then keep it. But there is always a room for improvement if you're able to analyze the business itself and look at what is causing you to have a subpar profitability or subpar cash profitability, right? So this company was growing, their pricing was increasing, their salaries and wages were growing, but they were not able to understand why their free cash itself was dropping, right? So that's the problem statement for us that, hey, I think there is something going on. I don't know what is going on. Can you please help me with this? So we started spending some time understanding their business and operations itself on what were they doing and across all the lines of business itself, what all services were they providing and how are each of the service lines growing themselves, right? So if I had to look at it purely from a employee utilization, that's a very critical number when you look at technology services businesses. Uh, if I have to look at employee utilization number, that gives me the anchor. Okay, if I'm still improving my utilization, I should have a lot more in terms of delta profitability, right? If I have the same assets, but I'm able to expand my capacity further. Or if you look at manufacturing, if I'm able to increase it from a 60% capacity utilization to an 80% capacity utilization, then my marginal cost should be slow or my step up cost should be nil. But in this case, in a services business specifically, they were doing all the right things, but they were not able to understand why they were not able to get that much cash back from all the success that they were able to achieve on the revenue. So when we started looking at them, so one thing is we look at markers, right? So we call it markers internally, are specific things that give you an indication that something is going right or something is going wrong. Now, when we started looking at the markers which are specific to this business, we realized that them as a company, they had to change the way that they were reporting itself. So the first thing that we set out to do was to diagnose what is the problem. Now, most of the times in organizations like this, once you get in, it becomes very, very complex because you have multiple divisions which are operating all differently. Each of them has different kind of client segment. They have different profitability. They have different pricing structures. But end of the day, for them, a client in and cash comes back into the system, and everything else is based on utilization of the workforce itself. So in their case, the first thing that we did was we established a new reporting language, right? Like we went very, very granular. We redid their whole chart of accounts. We said, hey, listen, I want you to get to the most granular level as possible from a cost capture angle. So if you can go to a single expense or a single bill that is there for travel, right? And I'm able to link it back to a certain project code or to a certain client code. That's my step number one, which is going to be to ensure that we are able to capture the right quality of data and the right amount of data about each of these businesses. The second thing is we started looking at extending what they mean when they say direct costs, what they mean as indirect cost. Let me give you an example. So a company like this, has a marketing division, right? So the marketing division which sells a particular service will not be the same, or at least the people within the marketing division who sell a particular service will not be the same people who sell another service. So if you take this example and say, somebody is selling, let's say, web development, right? Web development is, websites and Shopify and some Magento and basic level uh, uh, work from the web development angle, still not the technical or the large enterprise development projects. So when I say web development, I know the skill sets required in order to get more web development work is very basic compared to the people who are selling enterprise level software and applications, right? Like where they're talking to the customers with a completely different language. They're talking about 5 years and 7 years and solution sales. But in this case, it's about, hey, you have a need, and for that need, I'm going to give you a competitive pricing or a competitive bid to ensure that you get your website up, because there's a very tangible outcome and it's a very near-term outcome. The skill sets required in order for you to get that project itself is very low as compared to somebody who's selling a larger priced, a larger quality engagement, right? Or a engagement which stretches into a more number of years and where they have to do a number of validation checks before they tie up with a partner. So when we extended it, we went all the way back to the origination of a lead itself, right? Like where did the lead come from? Who got that lead? how much did it cost to get that lead onto the system, and drew it all the way down to post-sale support, right? For example, if I'm also spending X number of accounting hours on following up with a customer, we said that has to be included, right? Because the fundamental problem is with smaller check sizes or larger check sizes, the amount of follow-up is exactly the same, right? So we always ignore it, and then we say, by percentage revenue, let's do a simple allocation. But we said no, since your time is being captured, give us an idea of how much time you're spending on collecting from these accounts as compared to collecting with somebody else. It doesn't have to be specific to each account or each customer itself. It can just be from a line of business perspective that I spend, 2 hours a day following up on invoices that relate to, let's say, this web development as a vertical. And the next thing that we did is across all the LOBs, we standardized the reporting language itself. So we were talking the same numbers, we talking the same language. Uh, what this means is not only from the finance angle, but from the business unit angle as well. They were thinking about it from the same way. If they do not get this picture of how you are approaching problem solving itself, it becomes very difficult for them to grasp any kind of change or any kind of transformation, because they feel, it's a finance thing, right? Or yeah, CFO is trying something out. But you want them to be very involved into it. So we started, working with them to ensure that whatever language we were using to study or learn the business was flowing through to the people at a management level also. The next thing is we started defining or carving out these LOBs very clearly, right? So somebody who is in, let's say, web development also requires some amount of content development service, right? Like I'm developing a website for which I need a video to be developed. Now, it does not warrant two separate divisions to be studied simultaneously, because your other businesses are not going to feed you content development as a service. So we established certain guardrails for what web development as a business unit would do. And we started saying that, okay, this is not a web development project, right? Like, for example, you have a 3-year contract to support somebody's business. It's not a web development project by itself, because you're doing a lot more activities than just development. You're providing post-sales customer support, which is extending into a number of years. So we put these guardrails to ensure that whatever data we were studying was actually processable. Second thing is anything that we would do from a simulation angle would actually throw up good results, right? So when we did this LOB classification, account wise, project wise, teams were, some teams would have capacity, a certain extra number of hours, and they would participate. We said, no problem, right? It's absolutely fine. You don't have for management reporting or from a finance angle, you don't need to really get into the specifics of how they're doing business. You need to be able to accommodate what they're doing already as a business, and then see how you can study it from finance. The next thing is we question everything, right? Like, if you're allocating an expense and you're doing it by percentage of revenue, why? Isn't there a better way? Or if it's percentage of revenue itself, if they're using, a certain cost allocation angle, we had to question it, because most of these businesses themselves would not have visited how they're doing things, because nobody asked them from an external standpoint of why they were doing it in a particular way. And even if they would do in a particular way, they would say, yes, rule of thumb, most businesses like ours do this. But that's not enough answers, because you and the next business, who's situated probably 200 meters from your office, are not comparable at all, right? While you're doing the same business or services, you have different talent, you have different cost structures, you have different capabilities, you have different kind of clientele. So when you look at your business itself, everything should flow through from a rationale that you have designed or developed. So that's what we tried to do from a defined perspective, right? So the third thing that we did is like simple analysis, took out all the businesses, said, okay, what is my GP up to my GP level? What is my direct cost allocation? What is my indirect cost allocation? And then try to arrive at the profitability at a per LOB level. Now, this is all, plain vanilla. It's not too complicated. This is what most CFOs do. But the real edge of what a CFO would do is in the next step, right? So which is on how do you use this data itself? So for example, like here, I have tried my best to make things a little more, easy to look at. But this is typically what, for example, a LOB profitability study would look like, right? So when we looked at it, we analyzed it, we said, okay, some, divisions are kind of drawing out the profitability. In this company's case, they're doing about $11 million. They're generating about $3.5 million. Now everything going fine. they should be in a fantastic situation. And from a growth perspective, every dollar should relate back, but it's not. So when we try to kind of analyze, I mean, the form is less important than the function, but really it helps to understand it from a completely independent angle of what each of these numbers mean, because numbers tell a very critical or a very objective story that no other thing is going to tell you, right? So we modified the LOB and we started working with, okay, what is that one division? And, if we were to, hut off, right, that one division completely, like what is the company's profitability going to look like, right? How is the organization going to change? Because the costs related to that function have to be borne by somebody else. So we started looking at that as the first thing, right? Which is, bare minimum step that you should be considering from an organization. But where the role of a CFO kind of shifts, right, trajectory wise, it becomes more partner language and becomes less uh, about just the number crunching, is in how you carve out these strategies. So one of the tools that we kind of use is, after we've done the definition or the diagnosis of the problem, we say that, okay, division 4 is losing money, we are not able to fix it, and cutting off the entire division is not going to be the solution, right? So what is it, what are my different options that I have on the table, right? So one of the options that we kind of realize is, yes, this discontinue, you will face a certain amount of cash flow pressure, you'll face a certain amount of hit on the organization morale itself, because now this division that was there, you need to rescale, repurpose all the people. It has its own set of journey line that each of these strategies or each of these decisions is going to take. The second thing is, out of whatever I'm doing, is there a portion of the business which is profitable, right? Like, which is, very valuable. So when we looked at it, we said, okay, if somebody, comes in doing a platform business, right? So for example, they're working on, let's say, I'm sorry to use a more technical reference, but let's say I'm using Magento as the platform. Now, Magento development projects means that, I'm building, let's say, e-commerce site like Flipkart on a software which is already available in the market, but it's extremely profitable, right? Because it's not built grounds up. I have to only pay for the premium talent that is going to be on there. Now, if I discontinue everything that requires us to do, non-platform, right, which is going to be simple websites which are not e-commerce, then what happens, right? In that case, I will need to take the team that is there, which is working on certain other projects, the non-platform business itself, and I'll have to look at to find them placement, because this company as an organization, at least most companies of late, uh, do not want to pursue a hire and fire kind of a mindset, right? They want to groom these people to play larger roles within the organization. And they don't want the cost of their business decisions to be that somebody loses a livelihood, right? So, I mean, some businesses differ; they're more cutthroat than this. But in our case, at least the company that we work with or that we encountered said, I want to guard or I want to protect these guys. They've been with me through tough times. The third thing is, can I trim the projects itself, right? For example, if I'm able to trim every project which is less than, let's say, 20K a month, right? Or will I be able to do better, right? So, 20K a month is kind of at that anchor stage where less than 20K a month is not that profitable, or, the resources itself are very difficult to, retain. But the larger projects are the ones which are profitable. So, these are sample strategies. In this case, this was the exact case that we presented, that if we took a decision of, let's say, strategy 1, 2, 3, or 4, there's a strategy 4 as well. But if we choose one of these strategies, what is going to happen in the business itself, right? When we simulated it, we said, okay, there are multiple costs which come as a result of this rejig internally, right? So which is going to be that your management team is going to get freed up. They're not going to be utilized in the short term. So we forecasted what the monthly impact is going to be, what the quarterly impact is going to be, and what the annual impact is going to be of each of these strategies specifically. Now, how did we forecast it, right? So you'll have to look at the current growth of the company itself over a period of time. Try and see how, what the management has said is going to be their growth targets going in. see what the HR team is doing in terms of placement, what they believe the cost of new resources is going to be, or the cost of reskilling, retraining, or the cost of moving somebody from one division to another division, getting them, comfortable, because each of them has a different style of working, so they will need some amount of induction into the new division also. So we said, okay, we have strategy 1, 2, 3, 4. If we simulate it, what is going to happen from a P&L angle, right? So I mean, the text is really small. The idea is not to, kind of give you guys mathematical sheets to look at, but uh, when you start looking at things from this lens of these are the decisions and this is the outcome of a certain decision, it helps you to make an informed choice of what that decision has to be, right? Rather than saying that, for a strategy which you're taking of discontinue, right? Like most finance teams today will say, oh, yeah, I will, if we do this, we are going to save $20,000, right? Or we are going to save $40,000 or $50,000. Uh, but that's not what they're looking at. They're looking at it from a long-term point of view, because business today itself a little more complex. And when business itself is a little more complex, your degree of involvement or the kind of simulation that you run becomes a little more complex, right? It's not very rocket science-ish in the way it, I mean, it appears, these Excels do appear rocket science-ish, but they're really about logic, like how you approach the business, what your level of understanding is about the business, and how you're able to translate that into, let's say, forecasting or a strategic planning process. And when they had these four decisions, and we told them, that, the cost of making the next decision is going to be Y dollars, or it's going to be Y crores of rupees, or what the relative risks are going to be. So, for example, you moved a management team member from one division to the other division. Now, there is a probability that he's not going to like working in the new division, right? Because one, he might be reporting to somebody else, or the current projects that are there might have to be moved to him, which means he will be underutilized in the business itself. So you will have to factor all of those in, and then provide those disclaimers that this could happen, this could happen. But once you have synthesized it, right? Like, for example, if I were to share this deck with the CEO, he can look at this data or have a call with me as the CFO and say, oh, I want to evaluate what this means for the organization over the next 1 year, right? I don't want to take a call for the next month, because we're fairly funded from a cash flow angle, or we have enough reserves to be able to sustain the business for a year. But I want to evaluate what is going to happen from a yearly perspective. And that's the role that a CFO needs to play today, is to come out with these answers also, right? Come out with the decisions, come out with the actions that are going to be entailed, what the impact of those actions are, and how it influences their business model itself. Right? So from this particular case, at least, when we looked at it, the company decided to take the strategy of discontinuing all projects which have a $20,000 a month and below, right? So which means I will concentrate on key accounts that make money, that have a lot of value that are coming in, and there's a lot of predictability. I don't have to keep continuously, following up on invoices which are smaller in value, because the effort is more or less the same. I want to be able to focus my effort or management time on things that are more critical or important. Um, it would also mean that the current vertical itself would shrink in certain size. Right now, it won't shrink immediately. Like, you made that decision and you press that button, but it doesn't mean that oh, hey, tomorrow, all the projects are going to move. You have to create a sunset period of sorts when you will reach to that stage where you have a smaller division. And when you look at the smaller division, it would operate very profitably, which means that all the profitability draw that used to come from this particular vertical, right? In this particular vertical, there was a huge amount of draw coming in from the sales effort to get business. So normally, if you have a 12 to 15% cost allocation towards selling and marketing, for this division it was 30 to 40%, because it's quick business, and the people who are paid need to be incentivized well, because it's very easy for them to move from one organization to the other. It's very easy to build skill set itself to be able to sell a lower value service. Uh, the other bit was, how do I reskill these employees? So we started looking at where are the great performing engagements itself, and we started putting the resources from that vertical onto projects where we had a great client satisfaction, because that's the easiest way to get them to learn the good habits of working as an organization. And the key executives who were there, were some of the best executives in the organization. They have been with the company from day one. It's a legacy business for them. At one point of time, web development was all the rage, right? I mean, there was no concept of SaaS, there was no concept of these platforms. At that time, enterprise software was one vertical that existed, and web development was the other vertical that existed. And these are guys who have groomed themselves over a number of years into the values of the organization, into what makes the organization tick. They have created a lot of value internally about the teams that they've been working with. And when we repurpose their energy and effort into more valuable domains, right, which, let's say, more profitable domains, we were able to pay them more, right? As an organization, we were able to look at them and say, yeah, you're playing a different role in a larger group, which is more profitable. I am ready to incentivize you for the responsibilities you're taking. And they took to it, right? Some, obviously some of them will feel a little out of place because they will not be moving with the entire team that they were working with, or they will be breaking their comfort boundaries slightly. But most of the good senior executives were more than happy to make this switch because they realized that what they were working on was not going to be very valued in the organization, which meant that they will always be restricted from a growth and incentives perspective. So in this company, for a company which is doing about $11 million, the net effect of adding all of that management time over a 6-month period was about 110K a month, right? Which is a substantial number. Like if you look at $3.5 million, it's another $1 million that is getting added. Now, all of that is not this CFO's effort only, right? Or it's not our effort only. A lot of it has to do with the mindset itself with which they started reapproaching the business, right? Now they were thinking about them as a business unit, increasing the profitability from inside out. So that was one key thing. The second thing is when you look at the effort which goes into the utilization or retention of resources, it's much easier to retain a higher end resource as compared to a lower skill set resource, right? Because again, very tradable skill set. So in this case, they tended to stick longer. They tended to like the dynamic better, and because the switchover, we also kind of timed it with their annual programs. It became easier for them to digest that. Okay, this is a company. This is a company which is moving forward, right? It's not stagnating, and that gives a very positive vibe across the organization itself. So this is one case study that we encountered and that we worked with. Again, the approach that you choose can be extremely different. We tend to go with approach where we can control or we can predict the outcome. So there are certain approaches. For example, in this case, as an organization itself, they could have built out a product to save web development effort continuing. But that's not the business that they're in, or neither is it the business that we are in, right? We're not going to significantly change the way they do their business itself or the core objects of their business itself. We try and stick to the role that we can play of being a finance leader who helps them take decisions proactively. So, so far, do you guys have any questions about the first case study that I shared? Divya, would it be okay to go like that? I mean, or would you want me to just continue with the session? Or again, Saroj, I think.
So, but as of now, there are no questions. I request participants to kindly post your questions into Q&A column. I think so. We'll continue the session. We'll cross-check with some questions in some time.
Yeah, sure. I mean, the speed and tempo is fine, right, Divya? I mean,
Yeah, it is fine. Outside. Perfectly all right.
Okay. So, again, the next case study that I'm going to be taking is a manufacturing company. So, like I said, I just want to try and cover because, again, in terms of total quantum of companies, manufacturing far outweighs services businesses itself. So, this is another very interesting company that we work with. It's more than I think by now it should be more than 30 years old, but it's a company which has been making certain FMCG products for donkey's years, right? And they're a good company in terms of market share. For certain products that they have, 80% of market share is held by this one company and its products, right? So it's fantastic. Like the company itself from the outside is golden, right? You cannot find anything wrong. The management is very proactive. But one of the problems with you being a legacy business is also that you inherit legacy systems or legacy approaches. When we were brought on as part of a management decision to start focusing on the next 5-year roadmap or next 5-year plan, right? Which is similar to us. There could be other CFOs that were that were being considered, but the idea was that whoever they bring on board should be able to give them advice, because them as a business and operating day in and day out, their focus is continuously on the most tangible thing, which is sales, right? So production, again, I've set everything up. I've inherited a good, well functioning, well oiled engine. Now I don't need to focus too much on those bits. I need to focus more specifically on getting more business into the system, right? So they were a company growing steadily. The pricing was also growing, though the market is very competitive. They were able to get very, very small marginal increases in pricing and still be able to sell the product. The raw material costs to their pricing, the delta was always in favor of the company, so that was also a good thing. But where they kind of started suffering is any cost cutting measure that I would take would not deliver large size outcomes or large improvements, right? They would deliver a small little improvement, and even that improvement is sometimes become harder to sustain because the organization starts feeling they're very conscious about cost, right? I mean, these guys will not take a long-term decision. You don't want that message to continuously keep resonating through the organization. But anything that they did at a large size or scale was not able to give them the outcome that they wanted. And their EBITDA continued to drop as a percentage point, right? So we were brought in, we started saying that something's not right. If you look at it from an organization standpoint, you're able to manage a very good market share. You're at a decent size, right? You're not at probably, let's say, a $400 million or 400 crore kind of a company, which is on par with, let's say, ITCs and Kellogg's. But you are at the stage where any change that you make can lead to a substantial income. So that kind of worried us, right? So the next thing is, even from a manufacturing perspective, they had made a lot of capital expenditures over the last 5 years, which should have brought down my operating costs, right? It should have increased my efficiencies. It should have increased or reduced the amount of wastage. They had done a lot of these things, but it was just not somehow tying together into them being able to generate enough profits on their balance sheet. And whenever they try to do any kind of exercise to evaluate product line profitability or SKU wide profitability, there will be a huge variation, which then you can't operate in a decision, because let's assume that you are selling a certain kind of product, right? Like in this case, let's assume you're selling detergent. And there is another company, Harpic, which is selling detergent. Ariel is selling detergent now. Vim is selling detergent. All of them are pricing their products in a certain way and certain form and fashion. You are also making detergents. But if you're continuously, when you do an analysis of different types of detergents, I have liquid detergent and I have, for example, that the powdered detergent. Now, if I compare that to anybody else, my pricing is the same, right? My inputs are the same, like, because they also manufacture similarly. I also manufacture similarly. Output parameters are also the same. I'm able to achieve the X amount of conversion which they are able to achieve, right? Like everything seems fine, but as an organization, I'm still not able to run an SKU level profitability, or the SKU profitability that I run has a huge number of deviations. Like 50% of the product, in this case, almost like 30-40% of the product were in the red at purely at a GP level itself, right? So which means something is wrong, right? One is either you are in the wrong business, or second thing, the business that you are in, you're not able to study profit properly, because the systems that you have to study those costs or to study those numbers is not built to handle this kind of an analysis. So when we started working with the company, we said the first thing is we want to bring a level of granularity. So you will see one common language in operation as a CFO. The first thing that they do is go deep, right? They will go deep into the organization itself to make everything measurable, to put certain checkpoints, to put certain milestones, to put certain flags, in everything that they do as an organization. So we did that too. We said we want to bring in a new level of granularity. The entire production process is what we studied, right? We didn't say, hey, give me whatever data you have, and we want to see whether you're making any mistakes. We said, no, let's approach it completely afresh. Let's study every production line, what happens in each production line. Where is the spin-off moment for, let's say, a byproduct? Where is the spin-off moment for a waste? For every single thing, we started laying out these checkpoints, and we started correlating these checkpoints itself with financial costs and trying to see the implications of it. Right. So if a particular checkpoint had certain costs loaded onto it, we would look at how they would be allocated between the products that spun out of it. Now, that level of exercise, many organizations would have done maybe 10 years back, but as business has changed, they've never revisited it, right? They've changed the equipment that they use to run that line, but they've not revisited, or they've changed the manpower that is there, or they've added new technology, or they've added new packaging. But still, if you go back to them, they will say, this is something that works. I'm very comfortable, right? But we started going to that level and started drawing from that level links to, for example, capacity utilization, right? Like there on the slide, we started drawing links to capacity utilization. So if I'm operating, like I have a market share to put 20 tons of detergent into the market, I'm operating only at a 40% capacity utilization. Right? There is a certain cost which is associated with that, which is still getting borne. Now, the delta in terms of profitability can be significantly larger from going from, let's say, 40% to 60% or to 80%. So the number that I'm currently having purely at a unit cost level is wrong or is skewed, right? It's based on my inefficiency as an organization and not on the profitability of the product itself. So we started identifying these gaps too, and we started asking questions on, is this a revenue generating activity? So for example, if they would do a certain kind of packaging in a particular way, right? So for example, I do a combo offer, right? So I do a combo offer that you get 250 grams free of, let's say, the liquid detergent for every powder detergent that you buy, or 5 kilo powder detergent that you buy. Now, these combo offers themselves are, this whole activity itself was aimed at getting more revenue, but was it a revenue generating activity or not, right? So would people buy it at a lower price because I'm using this to load the costs on, or to shift the incidence of costs onto marketing from my production, right? So we were asking questions of, is this generating revenue or is this eating revenue, right? So we started looking at those kind of activities too. The second thing that we did is, it might be a little technical, but we started working on developing a very, very real-time data warehouse. Now, if you have an ERP or something like that, most of these things do happen on the ERP itself. But again, ERP is based on the maturity of the organization and adoption of features or functions. In this case, as an organization, while they did have an ERP, it was not extremely valuable in terms of output because somebody needs to study that analysis, right? Like they were not studying that analysis. And if you're not drawing the right linkages and drawing the right anchors, the data that you get is not capable of providing you any kind of prescriptive guidance of what you should be doing. It just gives you, okay, input, output, profitability, okay, line wastage. They give you those macro things, but purely at an individual unit level, no ERP will be able to do as much justice as a very good CFO can. Right? So we created a whole data warehouse which would capture information from the ERP, from the accounting software, and link all of that together on Excel, right? So to give you the capabilities to run very real-time analysis. So if I, for example, in my calculator, if I want to, I'm saying again from a spreadsheet calculator, if I want to generate the cost of this shipment made to this dealer or distributor, who's going to probably sit in Pollachi, right? So I want to calculate how much it costs to have it in front of his doorstep. Now that data is not available because it's a completely different places within the organization. So we created this data warehouse or a data lake to ensure that all the data that is possible to analyze is available in a single place. The third bit that we started doing was we started creating tools for the company and for the organization itself. So we started creating like a pricing tool, a costing tool. So if somebody wanted to punch in numbers, because we have all the data in the data warehouse, it would give a real-time analysis of what the cost of a particular order is going to be in this month. So I could put in and say, if I want to do 20 tons with this kind of discount pricing, and it's going to, let's say, I want to run this small campaign or the small dipstick in Pollachi itself. Now it will tell me what the costing on that is going to be or what the pricing should be, right? Like considering other factors, like if I'm selling a product, with some kind of sensitivity, if I'm selling a product at 30, I'm able to sell, let's say, 18 tons. If I'm selling a product at 25, I'm able to sell 25 tons. So with that kind of baked in, it would also give you a pricing calculator. The third thing that we went is most manufacturing companies don't want to set up all the things relating to the production themselves in-house. So there's a lot of job work going out. When the job work is going out, we started creating a tool where they can punch it in and they can say, this is the process that I want, and it will fetch real-time information on what the job work costing is and give them a buffer. Like if you need to negotiate, this is what you can negotiate on. And to tie all of this together, we introduced a new reporting format, right, for the company, so that the language which is there in any of these calculators is also the language that they're looking at the business in. Now, this helps to align them as an organization and to ensure that whatever is happening as an organization is providing enough input to make decisions or to make improved decisions. Now, apart from just this, right, we did a whole bunch of things for them. We started working on what are the non-moving product units, right? We started looking at asking questions about if you are doing a product or a business which is, or you're selling a particular SKU, which is continuously making losses. Why are you doing it? Like, is it going to be the product that brings somebody to the provision store, or is it going to be a product that helps you or that ensures that you have eye line visibility in a retail supermarket? Now we started asking those deeper and more thoughtful questions, because the role of a CFO is not to just kind of look at just what is happening as an organization and convert it to numbers, right? I mean, nobody really cares. You have to be able to provide guidance on what you can do as an organization to achieve those transformations or to achieve that what was there. So in this case, we started going all the way back, right? Like as I told you, we know the production line completely. 100% of the production line is there and is available to us to study. Now we started looking at what are the reorder quantities like, what is the cost of the reorder quantities. For example, if I want to buy, let's say I'm in the food processing division and I want to buy saffron, right? Saffron is used in the products that I make. If I want to buy saffron, the price for saffron has to be paid upfront to a dealer or to a producer, right? So that cost will not reflect in your balance sheet or P&L in any way. It will reflect only when you put the effort of saying that that is very different from the rate contracts with which I buy rice grain, right, which I use in my other products. Now, if you plug this in and you're saying that I have to pay in advance, 30 days in advance, the cost of that raw material should also flow through, right? Or sometimes somebody is not going to sell me, let's say, 20 kgs of saffron. They're going to say that for a B2B, I'm only going to sell 50 kgs. What they would do is they would take that 50 kgs that they would order and try to extend the shelf life as much as possible, store it well and things. But that kind of kills the purpose, right? Because saffron is a very expensive product. Even though it's sitting on your shelf, the possibility of pilferage or the possibility of damage is very, very high, because it's a very sensitive product. Like air itself is enough to degrade the quality of that saffron. And them as an organization, because nobody had asked them those questions, they never thought, okay, reorder levels actually can impact my profitability. They just, so when we started asking those questions, we started looking at things like holding cost, right? So if I'm going to be buying a certain quantity, how long is it going to be held by me? Or even if a certain product is going to be placed on a shelf and it's going to be sold in 3 months, my distributor is going to ask for 3 months, right? Because the distributor is going to give it to a retailer, and the retailer is going to take as much time as the ultimate retailer is going to take to sell the product. Now, all of these costs kind of load on to the margin that you can make. Though you're saying, cost minus 40 or retail sale price minus 40 or retail sale price minus 20. Net, it doesn't work out that way, because your ability to command a certain price will be based on your profitability too. So I might be able to choose, or I might have a lot more flexibility to choose a certain marketing approach for a product that is very, very profitable. But my ability to choose a marketing approach might get constricted if it's a product that I'm not able to get margins on. So the next thing that we did is, like I said, we kept asking them questions. why are you selling this product? Like, because when we redo the SKU profitability, I'll give you a very simple example. Let's assume that it is detergents itself. Now, the second product of your company is taken and kept in a household, right? It's kept in, by the lady of the house, purchases it, keeps it in her household. The amount of brand credibility that you build is fantastic, right? Because you look at large brands and how much they're spending on marketing and appealing to them, and you're able to enjoy that same shelf space, right? If it means giving a little bit of a discount, it's a good deal because it's going to lead to a lot more products being larger trust relationship being built. So in their case, even when they wanted to have a loss leader as a product or a category, it was a great thing. So one very simple example from the real world, right? So um, Tata is one of the most respected brands in every single household. Everybody knows about Tata, but think of the product from Tata that you use apart from Tata tea, right? I mean, Tata tea is again drunk by people mostly in the northern part of the country. Uh, but think of one other product. You can only think of Tata Salt, right? Like salt is the least margin product in the entire FMCG universe, right? There's very, very little margin that they can make. The people are very sensitive about the price, but your relationship as a household with Tata significantly grew. So when Tata Tea decided to release, and Tata, I think now they're coming up with a coffee line, but when they decided to release, they were already in every shelf, enjoying the goodwill of Tata Salt being a staple commodity in their household itself. Right. So that's how FMCG products work. There are some products which lose money, but help you sell better or sell your other product lines better. So sorry. In terms of negotiation power as well. So if you look at let's say conflicts, right? It's the hardest shelf to be on. Every single FMCG player in the country is trying to vie for that space in the conflicts aisle, and it's impossible to get it because the kind of discounts, margins, marketing budgets that somebody like a Kellogg's has is huge and unsurmountable, right? Like in a traditional retail market chain, it's very, very difficult to break through and create. And that's why you will see, even after years and years of there being a conflicts category, you will still see that there are only 2 or 3 options available. And even those 2 or 3 options that are available are occupying a huge amount of rack space in the supermarket, right? It's kind of begs to question that why is it that that's happening? Like that's the same thing with them as an organization. We have to bring this sensibility itself into the questions that we ask, because these can define the strategies for the company over the next 5 years or over the next 8 years. So we couldn't do the role that you have of number crunching. This is where it evolves into being a strategic finance thinker and a CFO partner. So we started doing this, and we started saying that, okay, if we discontinue X number of product lines of the company itself, what can happen from, for example, I will have to redo some amount of the branding exercise, right, to compensate for the fact that I don't have, uh, uh, you know, um, let's say I don't have, in Tata's case, I don't have Tata Salt anymore. I have to create another touch point so that my Tata tea will sell, right? Or I have to ensure that more households buy Tata tea, which means I need to, change the way I package or increase my product line. So uh, with them, we had to forecast that into a strategic forecast over the next 5 years, what that's going to mean, right? So when we came out with it, we said, okay, all the products that are loss leaders for us, we're going to continue doing, but with the cognizance that this has to lead to something. So if you look at let's say Flipkart's website, right? So if you try and look in the groceries aisle, you will always see sugar for 1 rupee, and you will see atta for 1 rupee, right? But you need to do a cart value of 60 rupees. Now, if you've ever wondered, nobody can manufacture at 1 rupee that package of atta. So you think, okay, it's a marketing gimmick, but think about the number of years that they've been running that particular campaign itself, right? Like been running it, I think from last 2 3 years, I've been seeing it. And in fact, the atta that I get at 1 rupee is I go in and give it to my office boy so that he can make rotis with it at a very, very cheap price. So uh, if you look at the way that business itself is functioning, it's because Atta draws regular orders into the website, right? So every time you come in, you see Atta and you add it into your cart, but that prompts you to fill up your grocery basket or your grocery cart. And when filling up your grocery cart, there are a huge number of products that actually have a huge amount of retail margin on them, which you'll see in your deals and promotions, which you also tend to add, right? So the way they use it is to reduce the amount of abandoned cart situations, because that 1 rupee thing will actually make you buy 600 rupees and will make you complete the transaction. Because one of the key problems in e-com is, does somebody complete the transaction or not? It's not about, you having the best discounts or you having the cheapest price. It's about how many people choose to do business with you. And that helps them. Second thing is, it tells them that you can tell your friend or you can tell your neighbor that, hey, listen, I got Atta for 1 rupee, right? So that's free of cost, word of mouth marketing. And if you are going to be able to facilitate that with something as critical as Atta, the number of users who would fill up the carts and the number of new users who would come to get that 1 rupee promotion or 1 rupee discount would be significant compared to you selling those X number of Atta, which cost about 40 rupees at 1 rupee. So in this company's case, when we started working with them, we said any kind of promo that you have needs to have this kind of risk return ratio, right? So that's another thing that we concentrated on. When we changed the focus on job work, they started, questioning on whether or not they should do this job work. So, for example, if I have cornflakes, which are just regular cornflakes, but I have the ones which have honey on them, which sell for maybe say 20 rupees more. Uh, but when I give it out for job work, because I don't do that honey infusion onto it, or I don't do the nuts onto it, or whatever thing, right? I'm just giving you an example. But if I believe that activity of this job work to convert it from regular cornflakes to honey-based cornflakes, they started questioning it. Earlier, they would say, it will cost me X amount, but I will get Y amount as revenue. But now I'm able to look at it all the way till the shelf, right? If it's going to be placed on the shelf, because my honey cornflakes can take longer to sell. Now, the margin that I make of, let's say, 20% can be very easily eaten away by my holding cost in the retail shelf, because the retailer is only going to pay when it sells, right? If I work with if I work with Big Bazaar, Big Bazaar is only going to pay me for X amount after X number of days. Is only going to pay me if the product sells. If it does not sell for whatever reason, it's expired, a large part of it will actually come back to you. Right? Your contracts will mention that you have to absorb the cost of products getting expired. So we started working with them. The next thing that we said, typical ABC costing itself, we started working with them on what is the kind of pilferage that you have in the raw materials, right? Apart from ABC costing, be very careful about store it separately, which is all your TQM basic controllership level stuff. But we started working with them on pilferage itself becoming a key anchor at the production level, right? So if I'm losing, for example, 1% on through pilferage, I have to be able to account it into my cost, right? So which throws a different kind of focus or a different kind of light, because you start conserving the more important raw materials and you start using them a little better. So net, as an organization, we were able to achieve, I think this entire transformation took about 9 to 12 months, something like that. But they were able to see a significant improvement in the organization itself, because they moved from a bare level EBIT, they moved to a very high percentage EBIT over a period of a year. Right? So this is kind of how, from a manufacturing perspective, there's a larger role you can play, which is not limited to you just being at the top of the just at the top. You're not providing guidance from what is coming from your balance sheet or what is coming from your P&L, but you're actually spending time to understand the business in detail. So this is the case study that I had on the manufacturing side, which I thought would be interesting, right? Because my idea, at least with these case studies, is to show you how deep you can go within the organization to add more value, while you stay extremely, flat at the top. You can look at every business for its individual uniqueness, because that's the key trait from a CFO, that they are able to absorb what makes that organization unique and able to contribute to their growth across the profitability and across the revenue. So, yeah, I think I've come a fair distance. I have been speaking for 1 hour and 10 minutes. So are there some questions that you would like me to go through, Divya, or we still don't have any?
So there are no questions, sir.
Okay, sure. So the last case study that I'm going to be looking at, so I'm a little concerned, to be honest, whether whether you guys are able to grasp this or not, or you're feeling that the way I'm communicating to you, I don't know, but I'm hoping that at least a large portion of you guys are able to absorb it. I'm again bypassing a lot of the things that we would have already known about or understood about, at least from a large majority angle. I'm kind of trying to stick to where the value can be added and try to give you, insider examples of how we did certain things. Because the idea behind a study circle is also that we're able to share practical experiences with each other. I don't want to get too theoretical on things. I just want to talk about what we have done, which could be things that you could do with your clients, with your organizations as CFOs, or even if you're kind of moving upward from the role of a finance manager, you're moving to a finance leadership role. It could be food for thought. So I'm hoping that you guys are getting value out of this. So with that in mind, I'll just move to the last case study that I have for the day. Um, Again, this is another tech company that we worked with about 4 or 5 years back. Um, Similar, very well functioning company, does extremely well, but they had a very unique challenge, right? So internally, it felt that they were very aggressive on receivables, and rightfully so. Because if you look at the services business, there is no credit. Your largest input that is there has to be paid on the 30th of the month. There is no other way to achieve that outcome, right? So what you do as an organization is continuously borrow, right? You continuously have a working capital line that you keep using because clients are not going to be able to pay you, or they're going to pay you on the 7th of the month, but you need to do your payroll on 30th. And 80% of the costs of the company are payroll. Now, I have absolutely no cash flow flexibility on that. And what happens is I translate the pressure onto the finance team and say, hey, collect fast, I mean, send more follow-ups or send more reminders. Hey, it's been 60 days since I received payment on this. Now, as an organization, that's fine, but it started costing the company once clients kind of started coming in and saying, I noticed this situation that you guys are following up on payment very aggressively, or one of the clients, outright mentioned that, hey, I don't like the fact that you guys push for payment so much. You have to understand that we are also running a business. We also have things to take care of. Now, these are all nice to hear, from especially when your clients are ready to speak up about some of these things. But internally, it destroys morale, right? Your finance team's job is not follow up on payments, right? If you ask them, they're going to say that's one of the functions that we do. But if I'm spending 50-60% of my time just sending out these reminders and things like that, it's going to become very difficult. And as a business unit or a business leader, they started feeling that this is how you can collect money. Right? This is the solution, right? That to put pressure on finance team to send those reminders out, collect the money. Because even though they're fantastic with the delivery side to it, this was causing a little bit of friction into the way they operate and manage things. So when we kind of started working with them, um, we started sensing that the finance team feels a little overburdened with this activity of collecting money, and especially when you have a number of small accounts, you're collecting like 5 lakh ka check, 3 lakh ka check, 1 lakh ka check. I mean, the volume takes a huge toll, and the size of the finance team itself will keep needing to grow to meet up to your business growth. I mean, the evidence of that, imagine like a 35 crore company having a 10-member finance team. I mean, it's, I think in this case, including the senior manager levels of finance, there were about 15 people, right? So 15 people collecting 5 million or 35 crores. I mean, it's obscene. that's the way you need to go, because you're putting so much pressure on them, and obviously they cannot do the roles that they have. Actually, about 50 things are there in their job description. They're probably only doing 5 of them every day, right? So and that's because they're overburdened with this activity. So when we approached it, we realized that the problem that they have, is very crucial. And we started noticing that when they started looking, when we asked them, how often do you do your cash flow forecast? So, every day, every day I get a cash flow report, and weekly I have a cash flow review. I said, that's a little too much, right? Considering you guys are growing well as an organization, you're profitable, your accounts or your customers like you, it seems a little overkill. And even you as an organization, the amount of time that you're spending collecting seems too much. I mean, and it's going to be a serious limitation to one, your growth itself. Second thing, nobody's going to want to stay in an environment, at least at the finance team level. Nobody's going to want to stay in an environment where there's so much pressure on collecting money, and that's absolutely outside their control, right? So we started looking at it, and we also started realizing that the DSO, or the average the credit period availed, is continuously growing on a day basis, right? So it shows us that something needs to not be going well for the organization. And the finance team itself, confided in us that there's a little bit of pressure in this organization. And that's when we said that there has to be a way to solve this, which is not going to be led by pressure, right? So the first thing that we did is we started saying, okay, let's pick just the daily sales outstanding as a critical problem to be solved, right? So every organization has some variant of this problem, but we started going deeper and deeper into it. We started studying how this is the act of raising an invoice. Like, how does a client delivery happen? How does the invoice get confirmed? How do they, follow up on payment? Because it's a whole chain of activity. You earn the revenue, at least in a services business, you earn the revenue when the time got spent, not when the invoice got raised, right? So we tried to say, okay, this gap should mean something for us as an organization to improve, right? So we looked at what are the people doing at an account management level, what are the people doing at the finance function level. So when they get an email, what happens before the email happens. So a lot of these larger organizations do this, I'll admit, but the fact that we started going into the operation side for the company started meaning that we're going a lot deeper than just saying let's do more of the pressure, right, to collect money. So we started going into the DSO, and we started, the first thing we said is, let's put certain targets of the DSO that we want. Like, let's have goals internally of what we want. Otherwise, we're not going to be working towards something, we're just going to be working. So we started putting in certain measurements that we want to be hitting. And the next thing that we said is in the process itself. So if you look at a typical services business, like I said, the revenue earning actually happened when the time got spent, right? If I had reconfirmed my timesheets a little in advance, for example, before the end of the month itself, I said, I have a pro forma invoice that I want you to confirm, like a pro forma timesheet that I want you to confirm, right? Or before the confirmation itself, I sent them a certain schedule of what this bill is going to entail, or what the costs that have been added is. I spent those 15 minutes educating the customer itself. It could have a delta impact because it makes it a lot easier for the customer to pass your invoice if he knows what is in the invoice. Right? It's not a guessing game anymore. So from that to, let's say, your follow-up, right? So the first follow-up that they would have, because there will be a huge pressure to bill everybody at the end of the month, the first 4 or 5 days they would concentrate on the management reporting and forget completely on follow-up. And then they would start the aggression on the follow-up again, and they have about 15-20 days to do that aggression part, and again get into the uh, get to be completely occupied with the month-end closing activities. So we started saying, okay, how do we improve the way we are following up itself, right? Like, can we ask to enroll their support, enroll a customer support? And the last thing that we said is, okay, is there a delta possibility of improvement in the collection process, right? So, like, let's do exactly what we're doing, but let's ease off the follow-ups. Like, we'll not send 10 follow-ups. We'll send them one follow-up and say, hey, listen, I want you to tell me a date rather than you giving me a blanket number or not responding to an email. Just give me a date, I will not follow up with you. It's a small little tweak actually, like, but it enrolls somebody else onto an action that they're not comfortable doing. So we started working with them and we said, okay, there is a 10-day possibility here, 7-day possibility here, 5-day possibility here. And net, can I add another, out of this, I don't need to get 100% gain of whatever possibility is there, right? I need to get just 2-day gain or 4-day gain, because my goal says for this quarter, I need to get a 2-day gain on my DSO. So when we looked at them, the next thing that we did is we said, okay, we are looking at it purely from finance out, right? Now let's look at how DSO can become an integral part of the account management activity itself. Because the person who is earning the revenue is also probably the most friendliest to the client or the closest to the client. So we started talking to business unit heads and saying that how can you influence the DSO, or an account manager, how can you influence the DSO? Now this is critical because not all the solutions will come from you, right? Sometimes people think of solutions because they are on the feet and they know the problems of the customer. They will be able to tell you something about how to collect from that account itself, rather than them sharing the invoice that you had sent to them and then you starting following. They would tell you, hey, listen, this customer I feel needs a little more time, just so that your process itself becomes smoother and becomes more intelligent. At the same time, for a customer that they know they can collect quickly, right? They would start working on how to ensure that collection happens, right? Like I told you earlier, if I can confirm the timesheets in advance, if I can confirm the performa invoice in advance, the later part of the activity which happens of actually sending those follow-ups might be much smoother, because in the customer's mind, he's already felt the liability to pay you, right? About 5 days or 6 days before itself you raise the invoice. Now, when we started working with the teams like this, they started also, giving volunteering out solutions. Now, uh, I I'll be the first to admit that the half the enrollment is cajoling interest, but sometimes they do come up with fantastic ideas of how you can do some problem solving for them. And here, in their case, they started saying, you know what, I can collect faster, because if you're saying DSO is a measurement tool, or is an important KPI that I need to be focusing on, I'll do it, right? No problem, right? But we started aligning incentives also in line with these DSO improvements, right? Because if you look at DSO, the true cost is the savings on the interest that I'm able to earn. So if I'm able to earn, let's say, $20,000, and I'm able to give that back to the department to spend, right? Their morale is going to be much better than me continuously putting pressure on finance, because everybody is dissatisfied, right? Like in this, who are motivated and who can cause the change are working towards causing that change for me. So we would start all of these activities much earlier into the project, into the cycle itself, and start working on them with the focus that it's a KPI, right? I need to ensure that on the accounts that I manage, I'm able to produce a super KPI, which will ensure that my appraisals go well or my incentives go well. So we help them to do that. The second thing is we created a small little support system, though it's a small organization. We created a support system that, hey, if you have an issue with payment, right, why don't you talk to this guy, because he solved it well, right? And or he's the champion of this cause. And he could very objectively bounce these things off without it coming to the CEO. Like the CEOs, I mean, they have the same 24 hours that anybody else in the organization has. And they don't want to be troubleshooting, which is the reason they had all those, cash flow plan and, weekly review and things like that. But they want to conserve as much time as they can to do high end or those, we in consulting call it as $1,000 hours, right? Like they want to do $1,000 an hour kind of work and not focus on this $10 an hour kind of work. And this started going to the mid-level management itself of somebody else who did it, and they would say, these are the ideas that I tried, these are the ideas that I tried. Now, when it comes from a peer as you getting it top down, the approach to solve the problem itself is very different, because they don't get dejected by failure. They don't have to come back and tell you that they failed, right? So, but with a peer, they don't mind discussing it. So we started creating this. And the third thing that we did is on improvements at a DSO level, we started having tiny, tiny reward systems or small little incentives or small little celebrations. Because when we baked in the concept that collection is an important part of the business and it is costing us, right? For example, it costs us X amount in terms of profitability. They will get the consciousness that they need to contribute to improve that. At least, a large majority of them will. And when you put it on their KPIs, everybody will, right? Because now it influences them specifically. So these incentives also kind of reinforce the fact that they need to work towards solving this problem for the company, or their role was a lot larger than just this. So that's how we were able to work with the company into over a period of time. Now, for them as an organization, they were able to reduce the DSO by 32%. This is a huge number. Like for a company which is 5 years old, which has been doing business as it has been, for about 3 to 4 months of an activity or a program like this, it's a substantial change, right? The amount of pressure it eases off on the organization is significant. Right? And here again, we're talking about, when we're quantifying, we're talking about the near-term measurement. We're not even talking about 5 years in the process that you as a CFO developed or built or put in place, and what value it is generating. Because we can only look at what it was earlier and once we came and what it became. But it's a huge amount of incentive that is there for a business to make that change or make that transformation. So that way, I feel it's a very rewarding exercise to kind of work with them on offbeat ideas to solve these problems, and not think of them as the typical problem with the typical solution. Right? Typical solution is put more pressure on the system. But once you keep putting pressure on any system, it's going to start breaking down. Right? When it breaks down, the first people who are going to be impacted are the people within that system itself, and the second people who are going to be impacted is going to be the management, because they have to be putting out fires continually. Even that single lost client, if you were able to salvage them with just the way you manage things on the payment side, they could become great accounts. But because they have this point of friction with you every month, they might start feeling that this is not a business that I'm very comfortable working with in the long run, right? So I think that way it's a critical piece of the puzzle that the company had to solve, and we were able to solve it with a little offbeat approach to it, and more of a people-based approach to solving a problem, rather than just put more number of measurements. Like if it was me in 14, 15 years back, I would have said, hey, yeah, put it in the KPIs. I think everybody's going to achieve. But the second we started that change of enrolling people onto the transformation, the results started occurring, because now people wanted this solution to work. Earlier, they would have followed a solution to the extent that they can, and they said, this is not my job. Right. So that's in a nutshell how the approach itself that we as a CFO can take in the organizations that we lead, which involves a lot more than just the financials, and just the numbers and performance metrics that are there. One very important thing that I would like to kind of bring to you guys, right, is if you look at the financial statements itself, right, we harp about the MIS, right? Like a lot of CFO advisory firms or outsourced CFO firms, they also talk a lot about, we provide MIS, but what they provide, or most CFOs think is MIS, is really the standard reporting format provided by the country, right? So you look at balance sheet, P&L, cash flow, they're in no way actionable. Like an MIS, even at large organizations that we have worked with, we are taken aback when their language of MIS is actually just a bunch of numbers on spreadsheets or in a PowerPoint. But if you look at revenue grew by 8% versus last year, that's not actionable, right? It's not giving you anything to think about. But if you were to say my value per account has grown, or the new accounts that were there, I started off compared to the last year when I started off with an account, right? Or I started off with a customer, I was able to grow the value. That becomes actionable, because now I'm talking about doing larger sized billings or larger sized deals, right? So in order for an MIS to be actionable, it's very important that you figure out that these are the 4, 5, 6 key metrics that they as an organization need to track and implement, and that same metric should be able to drill down into specific actionable points. Like whenever we talk to clients that we work with, we talk about root cause analysis, right? It's not enough that you have an indicator. You say, okay, this is red, this is green. Give me an indicator which gives me a root cause analysis, right? Like give me, for example, if I have DSO, like in the previous example we were discussing, if I have DSO as an indicator, now I need to have all those drill down metrics that go down, right? Like for example, how many days am I taking to collect at each of these places? What are the points of delay? What are the points where I could have chosen a much faster path, but I'm not choosing, right? So that has to total up into the DSO, which is the end outcome, right? That's the result of what activities I'm doing, and that's not going to provide me any action. If you say reduce your DSO, the standard response will be put more pressure on the team, right? But if I gave you drill down metrics and I said the time from revenue recognition to the invoicing was 3 days on average, right? Then you can say, hey, listen, we have 3 days of opportunity, right? If we were able to cast it a little better, we would be able to reduce that 3 to, let's say, 2. That's 1 day that we were not thinking about gaining that we are able to gain today. So that's another important distinction that we have to understand as professionals, that the standard reporting language is not the business reporting language, right? Nobody really cares. The metrics that are important from an organization are going to be those unit metrics or those key metrics that they as an organization can use and make decisions upon. So we have to mature from providing the management information to becoming decision support systems for them as well. So I guess that kind of brings me to a close for the session. I think I'm bang on time, so it's 7:30. 30 minutes, in case you guys have any questions, I'm more than happy to take up.
There's one question, sir,
Okay, sure.
asked by Ms. Randika. When we do CFO advisory, we only recommend or we also implement the suggestion and ensure the outcome?
Yeah, so that's a great question. So this is one of the places that the new advisory firms are kind of taking a departure from the traditional practice firms, right? So in order for you as an organization to or for example, let's say you're providing CFO advisory services, in order for you to really get the value or kind of get the bind with the account or with the client itself, is only when you're able to provide implementation of the recommendations as well, right? There are a number of people who will give you recommendations on paper and go away, but will not stand the test of time in terms of helping you implement those decisions or those or actually affect that or convert that into action points. uh, there are certain firms which do assist on implementation, and I feel in the long run, those are the firms that are going to stand the test of time. Like if you look at consulting itself, has gone through a huge change, and the way you can de-risk yourself in a situation where you're also participating on implementation is be very clear about the role that you want and the kind of buy-in that you want and the kind of expectations that you have from what the organization needs to do to make it happen, right? So if otherwise, it's a common problem. We have a problem that the more value you start adding, you become everything to everyone, right? So like finance manager is going to call you with a problem, the CEO is going to call you with a problem, and you only have X number of hours that are there, and not everything that you do honestly is billable hours, right? So but if you do take on implementation, it's about taking in quality accounts where you feel that it is possible for you to implement solutions as well. There are many organizations that we have also come across where, despite our best effort, right, in certain circumstances, we were not able to complete a transformation simply because when we tried to implement it, they were not receptive, right? It meant too many changes for them as a company or as an organization to absorb. But if you look at the journey of an organization over, let's say, or your relationship with an organization over a year, you should be able to execute change, and that is only when you will not be selling hours. This typical consulting approach of pay per hour, right? It's not going to be defined by that. It's going to be paid per result. So I hope I've answered that question, Radhika.
Yes, sir. So there are no further questions.
Yeah, so I think there's one other question I think which was posted, which was about how do you get management buy-in on the strategies that you have come up with, right? So this is again a very good question, because a large part of the work that you're doing with especially these leaders requires you to set a very strong ground base of trust, right? Because they are banking on you to make decisions which are critical, and they are going to second guess you, right? Because they've never been used to somebody external coming in and saying, I'm going to make all of these changes in your organization. Uh, so it takes some time for you to mature into that relationship, but the only way to bridge that gap or to kind of grow in that gap is do micro initiatives that give them value, right? Like tiny little things that provide them value every now and then and that will slowly tell them that you understand the business well enough to cause certain changes to happen, right? The next thing is you have to enroll. If you want the CEO to support you, he has to be told by the functional levels that they like to work with you, right? So one of the companies that we are working with right now, the first thing that we did, because a large part of the transformation work that we kind of do requires them, two hands to clap, right? We require them to also do their role. We spent a lot of time getting to know the team itself, right? Like every single member of the team, whether or not they were important or critical, we said, hey, we want to have a call with you, we want to understand all of you, and we started building a very personal rapport. So during the calls, we'd ask, hey, what is happening, how's family now. When that rapport starts building, they also are trying to root for you to deliver those initiatives. And when you deliver, right, just those micro initiatives kind of start building trust with the company. So for example, we won't do a whole gamut of do entire restructuring and change the way you're doing business. We'll start with, let me just tweak your pricing a little bit, right? Let me see, is there a room for making a small improvement in the organization? So you start with these tiny little things which kind of snowball into them at one point of time coming to you for every single decision, right? Whatever comes, even if it's a large contract, they'll say, hey, first I need to send it to send it to Pradyumna, or first I need to send it to my CFO, and only then will it will we take a call on it. So getting to that stage takes time, but once you do it, they stay on with you for a long time, because it's very difficult for them to build that relationship with somebody else. Yeah, so I hope I've answered the two questions that we had.
Okay. So there are no further questions, sir. Is it okay? We can close the session now? Or do you have
Yeah,
any?
please. So thanks for taking the time. Thanks for having me on. I hope people were not bored. I know it's a little late, and in Bangalore, it's the lockdown is just released. So I hope you guys found it useful. Thanks for having me on again.
Thank you so much, sir. I take this opportunity on behalf of Bangalore branch to present formal vote of thanks for today's program. On behalf of all the participants and also on behalf of entire managing committee members of Bangalore branch, I wholeheartedly thank you, sir, for sparing your valuable time and giving an excellent presentation. Thank you so much once again for being part of today's program and making it very knowledgeable.
Thank you, Divya. The pleasure was all mine.
Thank you so much, sir. Dear participants, thank you so much for all of you for your active participation. I request all of you to kindly look into Bangalore branch website for further programs. Thank you so much.